It's late January 2025. This is one of our clients who recently purchased a turnkey duplex in Oshawa, B plus neighborhood, still gentrifying. But there's a lot of talk out there. Ontario is no longer viable for investing. A lot of people exiting the province or the country. So wanted to highlight this. I mean, with Bill 23, it is still largely slept on. Ontario is currently largely slept on. There's these notions going around that there's no cash flow available. So what I've got here is a turnkey duplex. We're showing the capital outlay by year. We're showing the gross profit potential if sold by year, monthly cash flow, again, projected by year, and then the market value versus the mortgage balance by year, which is just an interesting way to look at exposure, right? And it also implies the strategy that underlies the financing for this throughout the 15-year period. So I'll talk a bit about that. And there's two scenarios covered here. One is this is already a turnkey duplex. The third unit, this client is actually very experienced in asset management. And it did a ton of the projections and vetting alongside, which is a little bit atypical, not the normal scenario. But two scenarios being modeled here. One is a turnkey duplex, which is legalized, already available on day one, with a third unit being added. And an ADU. This property has potential for both. There's still some more, obviously you have to go to the city, you have to get approval from, but so this set of columns here is the 4-unit scenario. So adding a third unit relatively quickly, and then an ADU potential down the road, approximately 3.5 years in. This set of columns here is just 3 units. So the turnkey duplex already, which cash flows on day one, combined with adding a third unit relatively quickly and then refinancing to reclaim most of the capital. Okay, so let's go through this. Purchase price is $800,000, down payment $160,000, closing cost $16,000, reserve fund, this is optional but highly recommended, $7.3K for a total of $183K. This is the closing costs for the turnkey duplex. There aren't renovations needed on this property at all. It's tenanted currently at good market rents. The tenants are great. I've met them both several times. So nothing needed on day one on this. Day one cash flow in both scenarios, obviously because there's nothing that changes on day one, is about $670K. That's with hard and soft costs included. Hard costs being mortgage, taxes, insurance. Soft costs being property management, maintenance, and vacancy fund. After those hard and soft costs, monthly cash flow, again, projected in both scenarios to be $670. Now let's look at the idea of adding a third unit, but then also a fourth, and what this means in terms of capital, and then I'll talk about gross profit if sold, because that speaks to risk and exposure, which is very important. It's inevitable. There's no money to be made without taking any risk. In fact, if you sit still, there's risk, and if you move, there's risk. There is no avoiding that. And so we'll talk about the risk exposure just so it can be, one, first and foremost, understood, and then two, managed. Okay, so the capital outlay by year, we just broke down the 183. The extra that adds up to 243 is around 70K to put in the third unit. Contractors have already gone through, already estimated this. So again, the contract's not signed, but reasonably solidified. And then followed by a refi, after which most of that capital gets reclaimed. What's left in is around 77K. Okay, so that's pretty fast reclaim of that capital to inside the first year. Around, where are we here? We're around 7 months in. This bump up in capital. So what happens here to produce the spike? Two things: we refi, and we get a bunch of the ADU funded, right? About 130K of the 300K ADU fund, which it may not cost that, right? The ADU might be a retrofit into the existing huge double car garage, which may be less than that 300K, but 300K is what's allocated here. So about 130 of that gets funded through a refi, which is, again, a bunch of the Blue Orchard hybrid strategy is exactly that model. So 130 comes through the refi. Then there's other capital, so 77 plus the other capital plus the 130 adds up to the 247. And then the refi reclaims all of that capital right around 4.5 years in, which is huge. As of 4.5 years, so this ROI projection from this point of the 77K is going to be super strong. But once you hit the 4.5 year mark, based on our projections, then it's an infinite ROI. All your capital's back, and you can look at doing another one of these, or you do 2 in parallel, or whatever your capital and risk tolerance allows. Okay, so gross profit by year in the scenario of 4 units. Let's look at this. This kind of dip in exposure is one way to look at this, is produced when the extra 70K is put in and the third unit's being created. Then after that, a normal refi happens. The risk exposure is now reduced, not eliminated. There's always risk in everything, but reduced. And so then you see the potential profit, if sold, being put back into the black. This dip right here is the addition of the ADU. So more capital goes in. If sold, let's say a week into that reno and all that capital is already given to the contractor, which you wouldn't do, but if it were, well, now your risk exposure is higher. After that's done, the risk exposure again is minimized after the refi and the 4th unit is installed. And now you see this growth, right? Monthly cash flow, let's talk about that. We see this dip in monthly cash flow while the 3rd unit's being put in, combined with a growth period, combined with another dip, and then growth after that. So in about 5 years, about 2,100 in cash flow, in about 10 years, 4,300, 15 years, about 6,100 in cash flow. That is all built on the underlying financing model, which says, yes, there's going to be an 80% LTV on the refis after the 3rd and 4th units, but after the 4th unit is put in, it's not going to be about reclaiming capital. You could do that, and that would change your cash flow. You're going to exchange equity growth for cash flow in these cases, right? So this model is built on not pulling out more capital at each interval that it would be available after that 4th unit isn't put in, but rather refining for the existing mortgage debt based on a new 5-year term, therefore maximizing equity, therefore maximizing cash flow, right? So this is what this model is built on. And again, there's different options for that. So then we look at market value versus mortgage balance. We see this relationship happening here. Again, the addition of the 3rd unit, addition of the 4th unit, followed by an increasing delta between mortgage and market value, which is something you'd like to see in your asset over time. Again, this isn't a get rich quick. It's a strategic view that helps us assess 3 units versus 4, the overall investment in both cases, and is this good from an overall, am I going to be happy I did this in 5 years? Am I going to be happy I did it in 10, 15? That's a good lens to look through to say, do I want to engage in this asset, in this investment? Is it going to be is the cost benefit largely worth it? Is it fitting my goals, right? These are the questions you want to ask, and the lenses you want to look through. Now let's look at the 3 units, and then we'll compare them side by side real quick. Okay, so 183, same capital in, that's down payment, closing cost, reserve fund, followed by the 60-70K for the 3rd unit, followed by the refi, puts us back down to the same 77K. And then in about 3.5 years, another refi would be possible, at which you'd reclaim your 77K and come away again with infinite ROI, a little bit quicker in this case. That's important, right? Because you can add a 4th unit doesn't mean you should add a 4th unit. It's about what is the best move to fit your goals. That's really what we want to be asking. Gross profit in sold, if sold by year. Again, a small amount of exposure here with the 3rd unit. And then it grows to 5 years, about 437, 10 years, about 995, 15 years, about 1.6. Monthly cash flow, 670, drops down 5 years, about 1,600, 10 years, about 33, 15 years, about 46. And then you see the same market value by mortgage balance, which is a little less volatile because we only have 3 units, not 4. Now let's look at this side by side. So on day 1, the cash flow is 670 in both scenarios. 5 year, the cash flow in 4 units is 2,200 versus 3 units is 1,600. Gross profit, this is interesting. 4 units is a little less, around 403 if sold in 5 years. If sold in 5 years for 3 units, about 437. So this is, in terms of gross profit, this is the one time frame in which 3 units surpasses 4 units. Now let's look at the 10-year projection for each. Cash flow 4,300 for 4 units, cash flow 3,300 for 3 units. Gross profit for 4 units 1.1, gross profit for 3 units 995. 15-year projection 6,200 in cash flow monthly for 4 units, 4,700 monthly for 3 units. Gross profit just over 2 million for 4 units and 1.74 for 3 units. And now there's a couple of key things here. One is the financing strategy isn't one of, the ATM model, keeping that 80% LTV throughout and getting constant capital reclaims. Reclaims to start, but then profits after all capital is paid back. So it's not built on refining it and keeping it hiked up at an 80% LTV. It's about a lower risk strategy of keeping the mortgage lower and the cash flow higher. The other thing to note here is, the delta between gross profit and you take a 10-year model. One investor might say, I like, the 4-unit model because I get more cash flow, more gross profit potential, but I also have this 4th unit, right, which in 15 years starts to really pay off. Another investor might say the delta between these two isn't worth the 4th unit, and or I don't have the extra capital to put in to build the ADU. Now, not everybody knows that today. Maybe you wait and see. It's nice, though, when you're purchasing these properties, and I've said this for a while and it still holds true today, the turnkey model with potential still is the sweet spot. And of primary, secondary, tertiary markets, secondaries are still the sweet spot. This one happens to be the primary, though. So it's not that the secondary is the sweet spot and the other ones are bad. Not at all. It's pros and cons, and that makes that secondary market the sweet spot. It's same with all of this stuff. Is 4 units better than 3? Not necessarily. Again, one investor might look at this model and say, I'm going to do 4 units, it's way better for me. The other one might say, well, all that extra capital and all the extra work of building the ADU for only a little bit more upside in 10 years doesn't make any sense to me. This is the value of one looking strategically and saying, is this a good investment for it? Look strategically over time, do a side-by-side comparison, look at the 10, 15-year model and see, is it right for you? Is this a smart move? The answer is not the same for everybody. The data is the same for everybody, or the projections are the same. The answer, not so much at all. And then again, being able to strategize and say, well, I've got at least a couple of different options. Third option, obviously, just keep it as a turnkey. What does that look like? Minimal effort, just maintenance over time, no renos, no refis, just kind of manage it over time. We could model that and put it beside these two as well. But that's really the heart of it, right? Step back, strategically look based on the data we have today. What can I see as my potential options? What then do I like it first? If no, walk away, re-strategize, think of a different model, think of a similar model but a different property. All of those things are totally fine options and ways to respond to this information. And then the second one is, if yes, I like this asset, then which of the strategies do I tend to lean toward? Not that you have to make that decision today, but it's nice to know roughly what it looks like, roughly what your options are. Does this fit me? Do I like the long term of this? That's the entire goal. And more than anything, this notion that you can't cash flow and that, there's no more money to be made in the Ontario real estate market. Nobody knows what's going to happen in the next year, let alone the next 5 or 10. But again, we've got a long history since the average prices were available since 1967. Throughout the GTA, we've got a long history of growth, right? Yes, we're in the midst of a correction, but a 50, 60-year trend is strong, let alone the study I've cited many times. The global study that looks across all investment assets looks across 13 of the major centers across the globe. So broad in terms of investment strategy or options, broad in terms of geographic region, it looks across everything over, I think it's 100, 120 years over time. So broad in terms of chronological domain, and real estate outperforms everything. And so, be very careful. I would say, again, I tend to look through this lens. It's not about, Ontario's good or bad. It's not about Calgary's good or bad. It's not about states versus Canada. It's not. That's not the right way to look at it, at least in my opinion. It's about the pros and cons of each. And so when you look at moving provinces or moving countries, remember, remote operations is not for the faint of heart. This is not a trivial undertaking to move away from your own backyard and start to do remote operations. Is it right for some people? 100%. Could you do both? Yes, you can, absolutely. But it tends to not be the type of language or thinking that you see out there in the collective, right? In social, you tend to see binary. This is good, that's bad, or this is good, therefore that's bad. Like, not at all. It's not how one should assess anything, at least in my opinion, but let alone investments. Okay, so this is the side-by-side on this, and gives us a day one view along with a 5, 10, 15-year projection and a couple of options solidified in chart format, and obviously there's a third, which is keep it as a turnkey and don't change anything. Okay, until our next one.